In this video, we are going to talk about stocks that pay dividends every month. So before starting this video, please like this video and subscribe to this channel for our future updates. Dividend stocks are attractive to income investors for a variety of reasons. The majority of dividend stocks pay out quarterly or annually, ensuring that investors have supplementary income to cover unexpected expenses. Assume that a company with a stock price of $50 pays a quarterly dividend with a 5% annual yield. An investor with 500 shares will earn $312.50 per 3 months, or $1,250 per year, assuming the stock price, and therefore the dividend yield, remains constant. 50 multiplied by 500 equals 25,000 multiplied by 0.05 equals $1,250 per 4 equals $312.50. Stocks in companies that pay regular dividends are regarded as secure investments. Once a corporation commits to paying a dividend, it will make every effort to keep paying it. Cutting or removing the dividend entirely would indicate that the company is experiencing financial difficulties. Another advantage of dividend stocks is compounding growth, which occurs when dividends are reinvested over time. When investors prefer dividend stocks that pay monthly dividends, both of these advantages are amplified. In reality, when it comes to compounding, investors who reinvest monthly dividends will typically see a substantial increase in their annual returns. Furthermore, while dividend stocks are less volatile than non-dividend stocks in general, stocks that pay monthly dividends are even less volatile, making them appealing to investors with a low risk tolerance. What businesses offer a monthly dividend? Utility stocks, as one would imagine, are represented. These securities also pay dividends, which are usually paid on a monthly basis. A real estate investment trust is another form of monthly dividend stock that is heavily represented in this presentation, REIT. Every month, REITs collect rent. They are forced by law to pay out at least 90% of their taxable income in dividends. As a result, paying dividends on a monthly basis allows them to properly manage their tax liabilities. Number 5. Pembina Pipeline Corporation, NYSE, PBA. Pembina Pipeline Corporation, NYSE, PBA, currently pays a 4.70% dividend yield. With a market capitalization of over $25 billion, Pembina Pipeline Corporation is a behemoth in the North American energy market. It completed the biggest transaction in its history in 2017 when it paid $7.1 billion for its competitor Vermilion. Since 2010, the company has raised daily production volume by 169% and cash dividends by 50% while keeping a manageable payout ratio of 55 to 60%. When looking at dividend stocks like PBA, however, it's reasonable to inquire about the future. With a host of projects slated to be game changers for the company and the stock, Pembina's future looks incredibly bright. The decision to proceed with the development of an integrated petrochemical facility in Canada is one of the most notable of these. This facility will turn propane into polypropylene when it is completed, allowing Pembina to move further downstream in the oil and gas supply chain. In 2019, the stock has gained nearly 17%. Pembina Pipeline Corporation offers oil sector transportation and midstream services. Pipelines, facilities, and marketing and new ventures are the company's 3 divisions. The pipelines division manages traditional, oil sands, and heavy oil pipelines, as well as transmission assets, with a daily transportation capacity of 3.1 million barrels of oil equivalent, ground storage capacity of 11 million barrels, and rail terminating capacity of approximately 145,000 barrels of oil equivalent, serving markets and basins throughout North America. Number 4. Vermilion Energy, NYSE, VET. Vermilion Energy is a company that specializes in renewable energy, NYSE, VET. The current dividend yield is 8.21%. Utility companies are well known for being decent dividend stocks, and when they pay out monthly dividends, it's even better. Vermilion Energy, a Canadian oil and gas company, is one example. VET. Investors considering VET should look beyond the utility's dividend yield of just over 8% and understand where the utility's assets are located. Their assets account for 60% of production in North America, with strong positions in Wyoming's Powder River Basin and Canada's gas-rich Mannville Play. In Australia's Wandoo Field, the company operates 2 permanently staffed offshore platforms. The company also enjoys premium prices from its gas fields in Europe. Spartan Energy, a Saskatchewan oil producer, was also purchased by the group in 2017. Hedge funds and institutional investors have recently shown interest in the company's stock, which is a bullish sign for investors. VET's stock had a consensus buy rating from analysts, as of March 1, 2019, with a target stock price of $40.50, confirming the signal. Vermilion Energy Inc., together with its subsidiaries, engages in the acquisition, exploration, development, and production of petroleum and natural gas in North America, Europe, and Australia. It owns 81% working interest in 642,300 net acres of developed land and 87% working interest in 376,700 net acres of undeveloped land, and 613 net producing natural gas wells and 3,034 net producing oil wells in Canada, and 96% working interest in 248,900 net acres of developed land and 91% working interest in 222,100 net acres of undeveloped land in the Aquitaine and Paris basins, and 325 net producing oil wells and 3.0 net producing gas wells in France. Number 3. Global Net Lease, Nyse, GNL. Global Net Lease, Nyse, GNL, currently has an 11.70% dividend yield. Global Net Lease is difficult to beat in terms of dividend yield. The firm has a market capitalization of $1.38 billion and a dividend yield of 11.70%. However, the increased risk comes with the increased reward. For GNL, the risk is some inconsistency in development. In 2017, for example, the company's funds from operations, FFO, per share fell by 18%. FFO, on the other hand, increased overall. The stock price has been on a roller coaster ride in 2019. The stock price rose over 13% at one point, but has since fallen, and although still positive for the year, is now only up 3%. Since 2018, the dividend payout ratio has been around 97%. Since 2012, the company has been paying out dividends, with the most recent raise coming in 2015. A portfolio with a high percentage of office, 56%, and industrial, 35% tenants helps to mitigate this risk. The retail business accounts for just 9% of the company's portfolio. Global Net Lease, Inc. Nyse, GNL, is a New York Stock Exchange-listed real estate investment trust focused on purchasing a diversified global portfolio of commercial properties, with a focus on sale-leaseback transactions involving single-occupant, mission-critical income-generating net leased assets in the United States, Western Europe, and Northern Europe. Number 2. Aple Hospitality REIT, Nyse, Aple. Aple Hospitality REIT, Nyse, Aple, currently pays a 7.33% dividend yield. The Aple Hospitality REIT is another REIT worth investigating. This trust focuses on the hotel industry, and it is one of the largest owners of select service and extended stay hotels in the industry. However, it has only 2 hotel chains in its portfolio, Hilton and Marriott, and it is among the top 5 Hilton and Marriott owners in the United States. The $3.66 billion REIT targets its 241 acquisitions on business travelers in 34 states, with special attention paid to markets such as Los Angeles, San Diego, Atlanta, Dallas, and Nashville. Aple has paid a consistent monthly dividend since being publicly traded in 2015, which is easily compensated by a healthy fund from operations, FPO, which was at 89 cents in the first half of 2018. The stock is up more than 13% this year. Apple Hospitality REIT, Inc. Nyse, Aple, is a publicly traded real estate investment trust, REIT, with one of the country's largest and most diverse portfolios of luxury, rooms-focused hotels. Apple Hospitality's portfolio includes 235 hotels with over 30,000 rooms spread across 87 markets in 34 states. Number 1. Realty Income, Nyse Smiley Face. Realty Income, Nyse, currently pays a 3.93% dividend yield. Realty Income is the first REIT that we'll look at, and with good reason. The business has increased its dividends for over 25 years in a row, making it a member of the Dividend Aristocrat Club. In addition, unlike the vast majority of REITs, Realty Income has been able to retain a credit rating of A or higher. The stock has been on an incredible run. The stock price has increased by 27% year over year, including a rise of just over 10% since the beginning of 2019. These are critical indicators for any stock, but they are especially important for a retail REIT. Retail tenants account for about 80% of their portfolio. However, a significant portion of the company's shares are in stocks of drugstore and dollar store chains, which include consumer necessities at rates comparable to e-commerce. In addition, Realty Income differs from other retail REITs in that about 20% of its portfolio is made up of non-retail spaces like offices and industrial properties. This adds another layer of diversification to the stock. According to forecasts, 94% of the company's portfolio income is safe from both e-commerce and recessions. Realty Income, the monthly dividend company, is an S&P 500 company committed to delivering dependable monthly income to stockholders. The corporation is organized as a REIT, and the cash flow from over 6,500 real estate assets purchased under long-term lease deals with our commercial clients supports monthly dividends. What do you think about our video? Are you planning to invest in a stock? Let us know in the comments below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button and turn on notifications before you go. Thanks for watching.